All right, so we're here with Sean Moir. Sean, appreciate you making the drive, man.
Of course.
Actually, you're close. I don't appreciate it at all. It's expected of you, Sean.
Well, and you know, the other thing too is a question of where you're driving, right?
Exactly.
Are you taking, the infamous 403 QEW, or are you going to take some of the back roads? Like, I drove down Dorval, past the golf course, and then I found my way underneath the highway. I didn't even know this place existed, being out in Waterdown and not really, Oakville. I had no idea you could drive under the highway there, and so I actually did have a nice drive. And
at the right time of day, I actually do a lot of thinking driving. It's when I come up with a lot of ideas. I don't know if it's good all the time. Sometimes I tell myself, I'm like, man, I feel like sometimes I drive like a drunk driver would. I'm not drunk. I'm not drinking. I'm completely sober, but I'm in thought elsewhere. And when I get to my destination, I'm like, I don't even remember getting here. Like, how the heck did I get here? You're just kind of on autopilot. But it's on the right day, it's great. As long as I'm not driving along the QEW into Toronto. And I find that anyone coming, from outside of Toronto proper, driving is not a big deal. But people from Toronto, they're just, when they come, like we have people that have come here from Etobicoke. Mm-hmm. It's not a far drive. It's like 20 minutes. And they're just like, yeah. And I'm like, oh, where are you coming in from? They're like, oh, all the way in Etobicoke. I'm like, hey, I could probably walk there, if I really needed to, but it's just the way different people look at things.
Well, I was out to St. Catharines twice last week. And that's, when I get back, I'm like, oh, I did 130 kilometer round trip.
Yeah.
And, to me, that starts to get up to a little bit of the size. When I was younger, I had a friend who lived out closer to the Chatham area, and I used to drive out there. And, that was a good 2.5, 3 hour drive.
Yeah.
That's when you start to feel.
That gets up there. Mm-hmm. To me, around here, anywhere around here, even St. Catharines, if there's no traffic, it's totally fine. Mm-hmm. Once you throw the traffic in, okay, then I can drive to Burlington and be unhappy about my drive.
That's the equalizer, traffic.
Yeah, 100%.
I a couple of years ago, I don't know, maybe it's becoming a father, just getting a little bit older, trying to understand your own personal faults. I used to really be a music listener in the car. And, the advent of Audible and audiobooks and podcasts really completely changed my approach to driving, because now I'm quite happy to listen to an audiobook or a podcast. And I don't want to say I don't want to get to my destination.
Yeah.
We all have things to do. But while I'm in the car and doing that drive, I'm listening to that podcast or listening to the audiobook. And I'm so interested in it. Somebody needs to go in front of me. Sure, no problem. I'm here with my audiobook. I'm here with my
you
podcast,
got time.
Right?
Have you ever listened to that book or read it? I think it's by David Goggins. It was his first one. It was Can't Hurt Me or Can't Break Me, I believe is one of the title. Have you ever
I haven't. No, it's something for me to add to my list.
Do you know David Goggins at all?
I don't.
Okay, so he's a pretty aggressive human. His story is incredible. Super out of shape, overweight guy, abusive household, stuff like that. Grew up, couldn't kind of like make it as anything. Ended up being a Navy SEAL after trying multiple times. Now he's just hardcore ultra marathoner, like all this crazy stuff. And the reason I'm sharing that is that was the one book that I was looking for places to drive, because I would get home and it was like, I'm like, oh, I want to hear what's going on next.
Yeah.
So, and that's what got me. That's one of the things that got me into the habit of just going for walks sometimes, is because I just go for a walk and listen to these, either a podcast or a book, and I love it. It's like, it's a way to get out there. But that book specifically was like, I could keep driving. I'm like, let me find someplace else to drive just to listen to more of it.
Yeah, it was interesting. What you were sort of getting to before is there's this engagement with your mind, right? And that's what people like this have done, is they've overcome the hurdle to be engaged to a level of time that is beyond what most people are able to do.
Yeah. And
I think we don't think about our biology enough when we think about our bodies. I mean, our brains are a muscle. We need to exercise it. We need to let it rest, but it can atrophy. And the way we consume media these days, the amount of, short attention span that most media has, it kind of, it's, as they say, rotting our brain away, right? And it just becomes a question of how can you engage yourself in a podcast that might be 45 minutes to an hour and keep your brain and that mental activity going. And it's not, you're not just listening to the cadence of the voice and having something in the background as you're thinking about what else you're doing. You're actually,
you're engaged in the conversation. You're learning it. You're absorbing it.
Mm-hmm. Yeah. And I'm sure the reason you sought out going to do that is the same way that somebody who's actively going to the gym seeks out going to the gym too, where it's like, wow, the chemicals inside my mind and my body are feeding me this rush, and I want to engage with it more, and push myself in the same way that somebody like that is able to have pushed beyond. And so any chance you have to engage the mind, such as, coming in and having a great conversation with you and doing this podcast, I think it's an opportunity for us all to revel in what it is to be a human.
Huh. Oh, that's deeper than I thought we were going. I thought we were going to talk about some financial stuff. No,
that's the morning coffee, right?
But so from that, I'm just curious, because in your world, like in the financial world, and you're always looking at different things, it's changing fast, especially now. Information is almost instant. How do you absorb what you need to absorb? How do you filter through and then listen to, read, research whatever you need to research?
Yeah.
Because there's so much flipping noise out there. We can't all really take our time and give our brain to anything that wants its attention, because that's the recipe for burnout real quick.
Sure. I appreciate the way you frame that, because I think there's a lot of time we can spend answering that question. I think it comes down to having a foundation, having a recipe. One of my mentors, Michael Lee Chin, said, what he did in life was he found somebody whom he could mimic. And he looked at what that recipe was that person was doing. And then he tried to replicate that recipe and just do it every single day, day in and day out, as a bit of a touchstone. It helps that his mentor, Warren Buffett, has been around for an exceptional period of time, a long human life, and has been very successful in what he's done. But he basically got that recipe, and he's duplicated it on an ongoing basis. And one of the things that I take a look at in what I do as a portfolio manager is I can say, well, what is the value add that I can provide to people? And that continues to evolve as time goes on. But certainly I believe why I will always have a profession as a portfolio manager is because of my mind and my engagement. And I think what I can do on behalf of my partners and clients is be engaged and sieve and filter that information through my knowledge and my experience in order to distill it down to them, to have a conversation with them, to be able to communicate in a clear fashion with them, to say, this is what the current environment is, this is how it relates to your goals, and let's not let the two things, become either too separated or too interlaced, right? And it's so easy when you're bombarded with information on a perpetual basis to go, does this apply to me? How should I change? Does this apply to me? How should I change? And you do it all day as you're reading, whether it be tweets or social media posts or, the newspaper or whatever your medium is to absorb information. And you always have to apply that to your own self, because as human beings, we're narcissistic and focused on what we have and what we can do. And it's a bit like my mom, watching the inauguration a couple of days ago, and, she has some of her thoughts. And, my father, who's also one of my mentors and business partners, said to my mom, I'm not going to give you an answer anymore from an emotional perspective, because now, I have to look at this from a logical perspective and say, how does this affect my clients and my life? And he said, at the end of the day, though,
So you mean Trump getting into power, you have to remove your emotion from it on the business side, no matter how you feel about the guy, whether you love him or hate him.
Sure.
You got to remove it, because you got to evaluate it just on what the potential is to impact the client's portfolios.
Exactly.
Gotcha.
Exactly. Because your own personal opinion is not everyone's personal opinion. And it's not the opinion of money either. Right?
Yeah. But with that guy, it's hard to do. Like, a lot of people can't, because I've tried to have this conversation with people before he recently got elected again. And I'm like, and I was evaluating his last presidency, and I'm like, I don't know, my opinion, like, let's remove his what he was putting on what was Twitter at the time and stuff. Like, let's remove that from the conversation. And people at that point, like, a lot of the conversations I had, they weren't able to remove the emotional side of it. They would bring the emotional side into every argument. I'm like, well, no, I thought we were just talking about well, how can you just talk about policy if you can't do that? I'm like, okay, well, then it's a different conversation.
Sure.
And I find it's hard for people to do that.
Yes, it is. The other thing too is that I think as human beings, we struggle to control our emotions to begin with. And this is a big part of investing, where control of your emotions is oftentimes the difference between success or failure. It's not necessarily information or information gap.
Oh, yeah.
It's your ability to control what you do with that information.
Oh, yeah. If you need clients that want to buy on the way up and sell on the way when it gets to the bottom. Like that's me, you know, like yeah, I'm perfect. I can buy high and sell low, and I can teach anyone to do that based purely on emotion. I'm a great stock trader. I'm also a great poker player for anyone who wants to play poker, because it lasts usually about 10 minutes before I'm just all in. I'm like, that's the patience level I got with my emotions.
And sometimes that's a winning strategy.
Yeah, sometimes it's actually worked, and I'm like, oh my God, I can't believe it. Yeah. But anyway, sorry.
So I guess what my dad was trying to say to my mom, and you know, what I'm trying to get across here is that, you know, what can you control? And we can't control what happens in a different country than ours. We certainly can't control what a president and those who surround him do. But what we can control is our emotional objectivity to that. And, you know, as human beings, I think we are constantly putting rules, systems, societies in place in order to be able to try and control and predict outcomes. You know, the reality is that, you know, we are a tiny speck of a planet in a relatively tiny solar system in an insignificant galaxy floating through an ever-expanding universe. You know, what does any of this have to do, you know?
Yeah.
Except when you back it up and go, we're all free radical particles, right? And how does that translate into finance? Well, I think it translates into it by the ability to control your emotions and to remove yourself and be objective to any situation. So that's how I sort of have to take a look at information, is go, you know, this is relevant, but I'm not absorbing it to necessarily have an opinion as I am to be able to then sieve it through to whomever I'm speaking with in the next couple of days, or to my general portfolio makeup at large.
Yeah. And it probably helps other people, like someone like myself, for example. Like the first time we met is we were going through a life insurance. We met through our former accountant who's passed away. We were going through some life insurance that we were looking at, and we met multiple times. And, you know, I was probably frustrated 5 minutes into the conversation, and you can you know, manage the emotional state that I was in, and then slowly we move forward from there. So I'd imagine that comes in handy, because probably a lot of people that you're dealing with when it comes to finances in certain situations, there's some sort of emotional reaction to some of their portfolio, whatever it is, like whether it's you know, anything from whatever, you know, tech stock to, you know, some sort of oil as a commodity or anything in between. It's just like there's emotions involved for people.
Yeah, you know, I appreciate something that just popped into my mind. Again, you know, you read through tons of information a day. And there was an article in the Global Mail about a week and a half ago that was referencing a study that was done. And the number one emotion that came up when it came to finances for people, the number one descriptive word was ashamed.
Really?
Ashamed. And I think that's because of a number of different things. I think, first of all, it's an education thing. I think people feel ashamed that they don't know more than they know. And they look at all the information that exists out there and they say, I have access to this information. Why don't I know more? Why couldn't I predict this? Why am I making these decisions? Why have I spent money on X, Y, and Z, and I'm sitting down with my advisor, my portfolio manager, and I'm saying, I only have $500 to put into my RSP right now, yeah. Or, you know, I didn't save anything last year. I took some money out, and then they feel ashamed of it. So there's all these different, you know, emotions that boil down to generally, you know, being ashamed. The other thing too is that, you know, there's a difference between the emotional outcome of a unit of positivity and an emotional outcome of a unit of negativity. So if you have a great year like last year, where most of the markets, you know, broad markets were up, you know, 15 to 30%, depending on which market we're talking about, that generally gives someone 1 unit of happiness, right? If I took a look a couple years ago and there was, you know, a pullback in the markets, even, you know, the TSX was down about 8% in 2022. You know, if you rank that relative to last year, TSX was up, you know, close to, you know, 20%, just shy of it, depending on whether you include dividends or not. Anybody would say that pain that they experience with their statements and with opening up their accounts or having conversations is generally twice as painful as the positivity they feel when they're opening their statements right now, looking at how last year went.
Yeah.
So for every unit of positivity, there's 2 units of negativity. So there's all these emotions that you know, surround us. And generally, I think human beings have, you know, loss aversion. And so, you know, if you read every piece of news media in a day, and you have loss aversion, and you feel the pain of loss twice as much as you feel gain, then you're going to avoid reading the financial press. And you're going to avoid trying to understand what's going on out there, because so much of what gets printed is negativity. And that feels twice as painful as when we read about something positive. Mm-hmm. And it's interesting how we process things like that.
And I get where you're coming from, because then if I feel like I've missed out on something for the financial side, but if you look at what's happened with a lot of media and stories and things like that go widespread, the negative stuff, like the reason there's a lot of negative headlines is they're clickbaity. People click on them. So I guess in one aspect, people kind of want that. Like they can't, it's almost like the car crash you can't look away from. Mm-hmm. They kind of want that. But then on the financial side, it's not so much about that. It's more like, oh, I don't want to see that because I missed out on it. So I don't, because of the pain that I'm feeling there, whereas the other one's just, maybe it's a story of interest or something else. Mm-hmm. Do you know what I mean? It seems like it's almost conflicting. But I'm curious, what do you think? Money is often like a taboo subject for people in a lot of families. And I don't know if you still find that. I'm curious if you still find that. I don't know. I was going to say with your clients, I'd say probably not with your clients, I would think. But maybe they do. So I'm curious if you still find that with your clients or just people in large. Do you think that's still kind of accurate, that it's a bit of a taboo subject, like that people avoid?
I 100% do.
Yeah.
Yes. Yes, it happens in the wealthiest families. It happens in those who are just starting up. And it's because it comes back to a lot of that, shame and
But what do they? I don't get it. What do they shame? Like they don't understand it. Like they don't.
Maybe they don't understand it. Maybe they don't have as much as they thought they should. Maybe they made some decisions that often again. Why is somebody going to have a conversation about it? It's maybe because something's bad happened and that's affected a change. When you're successful at anything, usually we're satisfied as people to allow that success to be unconscious.
Okay.
Right? How did we achieve that success? Do we sit down and go, oh, I did this, and then I did this, mm-hmm. and then I did that? Generally, no. We're just out celebrating, going, hey, look at the great year we've had. Look at the great decision we made. Look at the size of the bank account, whatever it might be. We celebrate it and we move on, right? But when something doesn't go right, you overanalyze it.
Yeah, I gotcha.
And you dwell on it. So again, you sit in that shame, right, about it. And then when you say, well, how can I pass this lesson on to the next generation, right? Maybe you're coming to that conversation with how do I expose these flaws in myself to my son or my daughter or whomever it might be, to my wife, to my husband, whatever the circumstance might be. That's one thought of it. But again, it's hard to distill rules of success. So again, when I think back about my framework and the framework of my mentors who've taught me, we're able to sort of distill and identify some things. We call it at Mandeville the 5 laws of wealth creation, right? So, what are those 5 laws? And think about anybody who's been very successful with their finances. And number 1, they've owned one or a few high quality businesses.
Okay. 2,
they understand those businesses very, very well.
You mean they've owned them as a shareholder, or they've owned them as like a control, almost like a controlling interest, like as more like an entrepreneur or business owner type thing?
Exactly. Yep. Either of those contexts would work.
Either of those, even as just a shareholder, like I've owned a small percentage of, like I've owned shares in General Electric 50 years ago.
Sure. I'm going to switch it back around once I get through all 5.
Oh, okay. So you're telling, that's a nice way of saying, Nick, shut up, I'm cutting you off.
Depending on how much podcasts you watch, right?
All right.
Depending on how raw they are. Number 3, those businesses or industries are long-term in nature.
Okay.
They're strong long-term businesses. Number 4 is there's some use of other people's money, whether it be, a collective investment or borrowing or what have you. And number 5 is the time in that investment was a long time, not 3 years long time or 5 years long time, but 15, 20, 25 years. And so I would turn around and I'd say, when you think about, yourself and your brother, what are the 2 things that have created the most value in your life from a financial perspective?
No, 100%. We haven't hidden that. The business has been very valuable, and the real estate that we started doing a long time ago, mm-hmm. And we've always talked about people as like our belief that, anyone that's seen success investing in real estate, it's the people have had long-term success has always been about time in the market, not timing the market. You know, and we've always looked at real estate because some people, they either speculate, and if they're just speculating, like trying to do it, it's almost like they're a trader. Like they're not really a real estate investor, they're a real estate trader or a speculator. And to us, that's a different thing, probably no different than, you know, if someone's a trader, whether it's I don't know if the term's day trader or whatever, if they're a trader versus they're investing and growing a portfolio with yourself or Mandeville or, you know, whoever, then to me, that seems like two different people. Is that?
And to circle back to what we first started talking about sieving through information and trying to understand things, that also is an important thing. If you if you understand an asset very well and you believe it's something for the long term, you know, today's news is like looking outside and going, oh, it's raining today or it's sunny today. But if you've built a home or you've built a seagoing vessel, it should be able to, you know, weather no matter what's happening out there. I know right now, right? My furnace that I have in my house is working really hard, and I thank goodness for putting in a strong furnace, even though I don't use that furnace 8 months of the year, really. You know, right now it's working hard, and I really appreciate putting a sound furnace in my house, and I can rely upon it, you know, for protecting my kids and my family in this cold snap we're in, right? So I've identified something that is necessary and long term, and what's going on in the news in that particular day. Do I want to understand it? Do I want to make sure that I have the right settings and my windows are, you know, the blinds are down, et cetera, et cetera? Sure, yeah, those little tweaks. But I still am building something that is meant for the long term, and I don't want to be trading it on a regular basis because, you know, when it comes to owning any asset, there's 3 stages. There's buying it, there's holding it, and there's selling it.
Hey, it's Anthony Molinaro from the Your Life, Your Term show, and I've got some exciting news. On Saturday, April 12th, we're hosting our biggest and most in-depth Your Life, Your Terms event yet in Mississauga, Ontario, and space is filling up fast. This is your chance to join us for a transformational day packed with powerful insights, strategies, and connections to help you live life on your terms. We'll be covering the biggest real estate opportunities, what's happening with the Canadian and global economy, how to protect and grow your wealth with Bitcoin and hard assets, and how to use marketing strategies and disruptive technologies to build freedom and income for yourself. But here's the deal. Tickets are going up the closer we get to the event, and with the early flood of registrations, we'll likely be hitting capacity. If you want to guarantee your seat and save some money, register now before it's too late. And remember, if you're a Rockstar Inner Circle member, your tickets are completely free for yourself and your guests. Head over to yourlifeyourtermsevent.com and secure your spot today. You don't want to miss this one. That's yourlifeyourtermsevent.com.
Whenever you buy an investment, you make the risk of being right and wrong. And whenever you sell an investment, you make the risk of being right and wrong, right? And the fewer decisions you can make, the less a chance you have of being right or wrong. And I think if you talk to professional investors who've been through many business cycles, they'll say, yeah, okay, maybe I got a batting average of 55%. If I'm really good, maybe I've got a batting average of 60%, right? Look at any face-off taker in the NHL, right? Nobody's really outside that 60% of success, right? Because we all have the same inputs, we all have the same education, et cetera, et cetera. And so, you know, the ability to be right and wrong, we're going to have both sides of that coin. So if I can make fewer decisions and concentrate on distilling the information down to making fewer decisions, perhaps I have a better outcome, a better percentage chance of being right. So again, when it comes to trading versus holding for the long term, that information might drive us to want to trade. But then if we can distill it to creating wealth over the long term by understanding what we're investing in it and holding it for the long term. And, you know. And
that's how you like to, so like you were mentioning Michael Lee Chin, and I don't know if this is coming from him or other mentors or just yourself, but you said like, I think the way you like to evaluate investments is and you mentioned Warren Buffett earlier, is the Warren Buffett way.
Yes, exactly. Just trying to understand and find and identify investments that are central to an economy, to a society, and to a population.
Coca-Cola.
Sure, exactly. I mean, it's my father, you know, bless him, he's 70 this year, as I've mentioned to him, you know, at least 300 times far. he's tried so many times during his life to say, okay, I'm off Coca-Cola. But he's still on. So
but I mean, I understand, because then there's insurance companies, there's railroad, like there's all sorts of other stuff, right? Yeah.
Exactly. But can we identify investments that are central to a society, but also that hopefully have a benefit to society as well? And this is something that you and I have talked about is we have a moral responsibility when it comes to life, especially if we're people who think about the future. We think about the betterment of humanity. We think about family. We want what's going to happen, not just today, but in the future, to be better. And that's how humanity's grown and strived for, the millennia that we've been around, is we try to do better for our kids and our grandkids than we have for ourselves. And so I think when it comes to investing, that's also a lens that you want to apply is this thing that I'm investing in adding value to, the human race and our ability to go forward? That's not to say we need to be altruistic, but it is to say that if it is going to add value to society, it's probably going to add value for a while. So it's also a good characteristic to say that this is something that is going to become central or is central to our way of life and adds value.
Yeah, no, look, it makes sense. It makes good sense. Things that just kind of, I don't want to say irreplaceable, because there's a lot of things that kind of, even in industries that have been around for a long time, things do morph and change, eventually. Sometimes, especially with technology, can kind of uproot some things, but it's the things that really, we rely on a regular basis every day that makes sense. It's one of the reasons we've always looked at real estate. We're just like, well, it's really, people need a place to live. Mm-hmm. It's been pretty simple. And now I know that's changed, because like over the last few years, the conversation around real estate, it's almost a bit of a pet peeve of mine, because it's all like everything's just about what's going on with prices, because everyone just got so fixated on the price of the property, which matters 100%. But it's all such short-term stuff. No one was investing. There was like a period of time where no one was investing. We've talked to investors there are people that have come in here and they're just like, I just needed more real estate. So I walked into a sales office and I bought 3 condos. Well, I'm like, do you know anything about them? Not really. I felt like I needed more. And I'm like, that's not investing, because I feel like now we're finally back at the days where people are like, well, I got to look at the property and see how much income the property generates. And I'm like, wow, like what a unique thought. If you're buying a piece of investment real estate, to look at the income that property can generate, but it sounds crazy, but for a period of time like that, it just disappeared. And I think that's kind of what happened. There's periods of time when the stock market's ripping, and it's the same kind of psychology that goes through, they're like, oh my God, like here's all the principled approach. Oh, I know that works, but that's kind of like boring. There's boring. Didn't you hear about this new AI company? Like it's gone from 3 cents to 27 cents. And I have a friend that tells me it's going to like $8, mm-hmm. And that's way more exciting. And people just jump on that train when everything's ripping. And then it's just like, I shouldn't say, nothing's, certainty, but it just means that the chances of that working out are slim to none.
Yes. There's a number of quotes that come to mind, with what you just said there. So another, just to harken back to Warren Buffett, this is often ascribed to him, which is price is what you pay, value is what you get, mm-hmm. right? Which I thought is interesting, relative to what you were just mentioning. People were worried about the price of things and not necessarily the value of things. They weren't necessarily looking into the underlying fundamentals of the property that they were purchasing, right? And then it circles back to, what we've talked about over and over again, fear and shame. So the question is, if something becomes obvious to your friend and you ignore it and then it's successful, how do you feel?
Yeah.
I'm ashamed I didn't participate. I should have followed your advice. What was
that's a nice way to look at it. Right? I feel the term that comes to mind is you asshole. That's the term that comes to mind.
The other phrase that people throw out a lot is fear of missing out, right? The FOMO, right? That we weren't in this and we weren't in that, but why? What's the fear?
Yeah.
Right? Is it keeping up with the Joneses? Is that the fear? Is it the fact that you'll have to look to your loved ones and go, hey, I didn't participate in this because I had some uncertainty, some misgivings, and was that the right decision? Am I ashamed of myself? I don't know. How can I look myself in the mirror and
is
go,
it fear or is it greed? Is it the chance at easy money?
Right. Yeah. Well, that's the question, right? That's the $1 million question. As John often will say in meetings, is he can give somebody an economics degree in 2 minutes. Okay, well, how? Well, let me give you 4 words: supply, demand, fear, and greed. Mm-hmm. That's what it's all about. What's the supply of X? What's the demand for X? How do we feel? Are we greedy about X, or are we fearful about X? Are we fearful about not participating in it? So greed and fear are the same side, same coin, but just different sides, but it's still the same coin, right? And the numbers behind it are the supply and demand question about it. But it's interesting how, these phrases, and the first time I heard John say it in a meeting was 20 years ago. And it's not changed. Yeah. So all this information that's happened, presidents and prime ministers and laws and tax changes.
Yeah, there's some constants.
But there's those constants. And that's the thing is, this is a human construct. Investing, money, fungibility, they're all human constructs. So what is the one constant that is here today and will be here 100 years from now, as long as we're not in the matrix, and there's AI that's running everything completely. And even there, who created AI? We did. So it'll have some of our faults, right? But I digress without going into that realm.
Yeah, that can be a deep conversation.
Sure, absolutely. It still comes down to the fact that this is a human construct. And so therefore it's filled with our flaws and our personality traits and our wants and our needs. And that part will never change, no matter what the news is of the day.
The index is like, with all the different financial products that came out, I don't know the numbers, but because you see them at the end of the year, there's always like reports like, oh, here's the hedge fund guys that beat the index, and this how many people, so you always see that type of stuff, especially on a good year, because the index, like you said, it was at what, 15 to 20 or 15 to 30, depending on what you're looking at. But what was the S&P last year was up? Probably,
something in the mid 20s.
Okay. So, okay, whatever. Let's round down to 20%. So, but, like I guess what I'm getting to is, if there's such a small percent of things that beat the index, because it's usually the vast minority that actually beat the index. Sometimes, some people must be like, why don't I should just, if I'm just going to do that, why play all this other game? You just do that, because if I can get mid 20% on that, it seems a lot easier. To your point, I don't have to make many decisions. Just buy that index.
Yeah, it's a very interesting thought, and the answer, of course, is that there is no right answer.
Yeah,
it depends on each individual's personal portfolio and their individual personality traits, and that might sound like a bit of a cop-out answer, except that I'm going to get into it a little bit deeper. But it's true. So I don't, for my portfolio, my personal portfolio, I don't buy any indexes.
Okay.
Why? Because I don't care. I want to own a business. I want to understand what that business does.
Got it.
And I want to own that business for the long term. I am an owner of a business. I'm not an investor or a speculator. I'm an owner of that business. I want to, be able to march down to their head office and say, "This is my listing as shareholders, and this is how I vote, and et cetera, et cetera. And I'm reading your reports and I'm understanding them, et cetera, et cetera." I like owning businesses, so I don't care about an index. If I'm talking to an institution that's managing money on a fiduciary basis on behalf of somebody else, if they've built themselves an investment policy statement with an index to replicate and or match or beat or what have you, I often will say to them, why would you want to take on a single incremental bit of risk to not just invest in that particular index? So if their benchmark for their institutional portfolio is the S&P 500 for that sleeve of equity investments, just buy the S&P 500.
So some offices, or the way some financial, I don't know if the term's advisors or portfolio managers, the way they'll work is they'll have a mandate to try to kind of mimic the index or something? Is that kind of like that?
The question is how does one hire or fire the weatherman?
Okay.
Right? Do they do so based on how many weather reports he gets accurate, or do they do so based on whether or not he follows the scientific rigor thoroughly? Right? Same question, right? So if you're hiring somebody to try and do a job? Are you trying to get them because of their accuracy, or are you trying to get them because they communicate with you, et cetera, et cetera? So when it comes to trying to match a mandate, why would you go outside of what,
So what, just so I'm clear, sorry, some people have the mandate of trying to match the return of the index.
If they're an institution, or if they think from an institutional perspective. Yeah.
Oh, so that's the goal. It's like some people's goal, that's what they set out to do.
Mm-hmm. Yeah, because
I see. And then why take on the risk, in your opinion, what you're sharing, and just correct me if I'm wrong, but why take on the risk of now you're an added risk of this person has to make these decisions to try to mimic the index, but when instead you could just buy the index.
Exactly.
So if you're trying to do the same thing through another avenue and adding risk to it, what's the point?
Right.
Yeah.
So if you go back to, if you go back to trying to say, well, what is the purpose of investing, right? The purpose of investing is to keep up with inflation, right? Because otherwise, why would we take any single risk that would exist, right? We would just keep our money in our pocket, right?
Yeah.
We are trying to keep up with inflation because we know the cost of everything goes up. So over the history of investing, buying equities helps you keep up with inflation, and in some circumstances exceed inflation. It's pretty consistent that if you look at the S&P 500 or the TSX over the long term, it has a real return that is positive. And a real return means that there is a return in excess of inflation. And so
I'm going to let you finish and then circle back to this, because you know about with inflation, we have to circle back to that. So yeah,
absolutely. So if the question is, my goal is to outperform inflation, and here is an instrument that's existed for decades and can be accessed, very inexpensively, why am I complicating my life?
Yeah. So why are you?
By picking individual securities.
Yeah.
Okay. So again, I like to do it because I like to own businesses, right? Okay. But for an average investor, and Warren Buffett will come out and say this, he'll say, just buy the index. Like, don't complicate your life, just buy the index. Now, when it comes to indexes and the number of options available, like you were sort of bringing up before, the question becomes, well, that's a moving goal, because there are thousands of indexes. There are large institutions out there, Dow Jones, S&P, Morgan Stanley, the Financial Times. They come up with indexes,
but
like it's going out of style.
Isn't it kind of not the gold standard, but the main one people really follow is the S&P?
Right now it is, but for almost 100 years it was the Dow Jones.
Yeah, you're right. Even like in my, when not too long ago, I don't follow markets much, but it felt like it was the Dow more often before.
And the Dow is a completely different animal, because first of all, the Dow is, there's a committee that selects, what is added or removed from the Dow, from the 30 names there, given what they're doing. And then I'm not sure if you're aware of this or listeners are aware of this, but the Dow is also price weighted. It's not market capitalization weighted. Oh. So it doesn't matter if Apple is a $3 trillion company. The fact that Apple's share price is $300 versus, let's say NVIDIA, which is, catching up to Apple, and its market cap is $140. The weighting of, if they were both on the Dow 30, the weighting of Apple would be twice the weighting of NVIDIA, because it's a $300 company versus a $140 company. Yeah. Right. So, for the longest time, everybody just talked about the Dow. What's the Dow doing? Now over the past decade, it's morphed into the S&P 500. But if you take a look, actually the NASDAQ is the better performing index over the past decade. Right. So what index, right? Now, when I first started in the business back in 2005, nobody wanted to invest in the S&P 500. Everyone wanted to invest in the TSX.
Yeah. And probably not the NASDAQ at that time, because it had gone up and was in the doldrums of that. It was down for a while, right? So no one was looking at the tech world for a while.
Exactly. And I used to have the conversation with people when I first started in the business going, hey, the TSX is pretty much only banks and energy companies. So if you just track the TSX and you just buy the TSX, okay, I understand your point. You just want to get the index return, but you're pretty much just buying financials and energy. Mm-hmm. And then the worm turned around the great financial crisis and what's gone on with the world after that. And it started to be a little bit more where the returns came from tech. And so over the past decade, there's been a massive underperformance of the TSX to the S&P 500. So if you locked in that mentality of just buying the TSX back in the 2000s, and then we came into the 2010s, and you were like, no, just buy the S&P 500. Well, the goalposts have changed.
Got it.
So we delude ourselves in saying, let's make things simple. Let's just track an index. Which index?
Yeah, because it changes.
For how long?
Time. Yeah. Okay.
Right? Exactly. So then you're left with that situation where, again, what affects the index, and what am I actually investing in the index? And there was some time when the S&P 500 was a good diversified index. At this point now, the 7 largest companies in the S&P 500 are controlling everything that's gone on. So last year there was earnings growth of the top 7 companies on the S&P 500 around about 30-ish%. Mm-hmm. The remaining 493 companies had earnings growth of pretty much 3 to 5%.
I know, it's kind of outrageous. Eh?
Right. So, you can say, oh, well, that's why the Magnificent Seven did so great last year, and it's great, good for them. And, that's when you're buying the S&P 500, you're really buying the S&P 7 mm-hmm. and getting the other 493 tossed in for fun, right? It used to not be that way.
Yeah, but lately technology's just really kind of ruled.
Exactly. And so the question becomes, well, okay, so now am I buying the S&P 500 or am I buying the S&P 500 equal weight? Maybe I want to go out and I want to buy the equal weight index so that I'm not so heavily weighted to these top companies. And you start to creep into this drift that happens. And so it's hard being an indexer. It's not as easy as it looks. Yeah,
okay, I get you. Versus, and then your approach is to research the company and own the company. But let me come back to something, because I want to make sure we I circle back before I forget. Because something you said the price of everything goes up, and then you talked about inflation. So I'm curious, what hurdle rate do you use for inflation on a yearly basis?
Mm-hmm. Yeah, so
because do you use the Canadian government one?
Yeah, oftentimes I would relate to the CPI. Well, why? Because that's what's generally accepted, right? Got it. What you could do, and what we will often do, is we'll talk about, well, what's the cash rate, right? Because if you took no risk with your portfolio, you just went out and you bought a GIC, right? Or you bought a high interest savings account or what have you. That's the cash rate. And so if you're taking more risk than cash, you want to have a commensurate alpha mm-hmm. to that, and outperformance to it, right? So that's where you can say, well, instead of relating to CPI, you could rate it to cash. I want to outperform cash.
What do you think about looking at the M2, the growth in M2?
Yeah, sure. The supply of money is obviously very influential in what happens to the prices of assets, mm-hmm. right? Because the more money people have, the more they need to do something with that money, which means they're going to buy something with that money, which is going to drive up assets, which is asset inflation, which is what we saw a lot of over the past 15 years.
Yeah. We mapped out M2 growth against asset price growth, and it's the correlation gets quite interesting, because if you look at real estate historically, I'm going to forget the years exactly. I think it was was it 69 or 60? I don't know, something, 1960 something. Look, the average increase in Toronto real estate. Remember, this is average, so it's anything from condos to multi-million-dollar property. So it's it's not it's a perfect science, but it's roughly around 7%. I think it's about 6.9%, and the M2 growth is roughly about 7.2%. So it gets interesting with the asset inflation. So when we look at that, and
so that your real return there, if you say inflation is M2, then your real return is 0.
Well, yeah, unless I was investing in other things, and then that's what's. You're right. My real return might be 0, but it's allowing me to protect my purchasing power.
Yes, exactly. Because again, what's the goal of investing? Protecting your purchasing power.
Yeah, which is like the only reason that investing really. It's almost like we're forced to have to be investors these days, because we're being stripped of our purchasing power. So if I just leave the money in the bank, because our money's in my opinion, the money's broken. Because if I'm losing, if they're printing 7% more, creating 7% more every year on average, and I'm losing at 7% every year, that's pretty nasty. That's a pretty nasty theft. So then I'm like, I'm not going to do this. So then I'm like, yeah, I need to invest. It's like in some ways we look at our business, and I'll expand it to some facets of your industry as well, that the only reason our business exists and parts of that industry is because of crappy government financial policies.
I don't know if it's government financial policy. I think it's just capitalism.
Well, I'm just talking, but see, I don't believe that. Like, I think you can have capitalism with a good money, with a solid money, because if you take away the amount of inflation, the growing amount of inflation that is not just government, but I place a lot of the blame on the government because of deficit spending and the borrowing and the debt that they've incurred and those types of things. And a lot of that money doesn't go to fruitful innovation or proper investment. It goes to waste, right? And I'll rip on the government all day long, so I have no problems with that. But and there's just countless examples of that. Like, it's just ridiculous, right? But if you remove that, you don't need to then expand the money supply the same way. Because if I could save $100 today, and fuck it almost doesn't buy me anything anymore. But okay, so let's say $1,000, because then maybe I can buy something with it. If I can save $1,000 today and know that $1,000 will buy me the same amount of goods 10, 15, 20 years from today, then maybe I'm going to invest, because I might still want to own a company. I still want to outperform that. But my incentive to invest has dropped dramatically, because this $1,000 is still going to be worth something. Whereas if I don't invest it, it's basically worth nothing.
So this comes back to something we talked about a long time ago in this podcast, right? Very much early in the beginning, where I talked about the universe. The universe is always expanding, right? If you stand still, you'll be left behind by the expansion of the universe, and you will become smaller as a proportionate percentage of that universe as it ever expands, right? It's very much the same thing with capitalism. It's always expanding. It's always going to have inflation, because you need to drive and motivate things. If we were in if we were in a pseudo socialist communist type environment where you had controlled pricing, which is not having inflation, you have controlled pricing, you lose the motivational factor. Okay, so if I said, hey, I can buy something for $100 and I never have to worry about it changing in price again, well, what's my motivation to innovate that thing?
Yes, I agree with what you're saying.
What's my motivation to work harder than the person next to me?
Okay.
Right? So I think inflation naturally happens. Can inflation be higher than it is?
Hold on. This is where I don't get where you're coming from with naturally happens. How can it naturally happen? Who's determining? Because it's not a force of nature. People are making decisions to then allow for inflation. So that's the only thing that I'm confused by what you're saying. Like, I understand the universe and things are growing and stuff like that. So keep that and come back to that for a second, because the naturally thing is confused, because the naturally thing is the central bank starts dropping rates so people can create more money, or the government overspends and borrows more money to throw into the system. And that's not natural, in my opinion. Now, hold on. Sorry. I just want to come back to one thing. Yeah. And on that same thing, and hold on. And then, because I want to add a layer onto that, because if we look at the current system of the world with our advancements. So if you look at capitalism drives advances in the system, and it drives for efficiencies. And because that's what capitalism is. If there's a demand for something, people want to make more of it cheaper so that they can then provide that, and they get to make additional profit. With the advances in technology, I'm confused as to why, and this is from Jeff Booth's work in his book, Price of Tomorrow, and I think he brings up a valid point. Why then, with all the advances in technology, aren't we in a natural state of deflation with things? And if we're in a natural state of deflation, then why do things have to get more expensive? It doesn't actually, there's something that doesn't align for me.
Yeah, so deflation really translates into the dollar going up in value, right? Your static dollar going up in value, because it can buy more tomorrow.
100%.
Okay, so if you know that your dollar,
like the phone, the iPhone, right?
If you know that your dollar is going to be worth more tomorrow, why are you getting out of bed?
Yeah, you're right.
Okay, if your phone is going to be worth $100 next year, okay, so why would you ever buy another phone?
but I'll get out of bed to do what I want to do with my life, to not be enslaved into the system.
So then we're getting into utopia and what could I actually do with my life instead of earning money? I mean, I'd love to just go sing and perform.
No, there's still earnings. There's still earnings because unless you have savings and unless you've created enough value for people to have savings, then that doesn't matter. And there's all sorts of things that won't be deflationary, but there are certain things that will be.
Sure. I mean, look at this office. We got a beautiful flat screen TV on the wall there.
Yeah, that at one point was probably $50,000 and now it's $300.
Exactly. So we have had deflation on things that are disposable, and we've had inflation on things that are hard to replace and replicate. So when you want to allocate your capital, you want to allocate your capital to things that have value and will continue to have value or improve on that value. That's buying an asset versus something like TV, which is deflationary. It's something that's replaceable. So again, if you don't go out and buy a new phone because it's still worth $100, somebody doesn't have a job to make that new phone. And Apple is not inclined to build a better phone because they've got a phone that's gone up in value or stayed the same value. So inflation comes from velocity of money and the transactions that occur. And because those transactions are not connected, they're disparate transactions from disparate peoples in different geography and different types of items. That's what creates inflation, is that information disconnect in all those transactions.
Okay.
And the velocity of money there. Now, what you, I think, inherently object to is inflation that is beyond what is probably necessary. So the printing of money more than what was needed to keep things going and happy, right?
Okay.
And that's what makes the central banker job so challenging, is how does one determine what that amount of money is? And then how can we make sure that that money gets pushed out by all the operators that exist out there, whether that be financial institutions making loans to new startup enterprises, et cetera, et cetera. But so again, just to circle back, I would say that human nature creates inflation. So it is natural.
Yeah, okay, because I want you to come back to this. Okay.
Right.
So how does human nature create inflation?
Because
you said the central bankers do. No, you did. I just said it's a tough job.
Yeah,
but you're saying human nature.
Yeah, because we want to do better. We want to be motivated. Human nature is, if we're not going to get paid more, if we don't have the drive to exceed inflation, what's our motivation to put in the grind, right? And listen, we might get to a place where we need to have a serious conversation and go, do we need to have 5% unemployment? Or can we not get to a place where, thanks to technology, we could have 50% unemployment? And that doesn't mean people are going to sit in bed and not do anything. It's like my favorite first passion is to sing and act and do, stage productions and things. But that's not changing the world and innovating science, et cetera, et cetera.
Yeah.
So I'm not going to get paid to do that.
You're right. Unless you're very good at it and you provide enough value.
Supply and demand.
No, 100%, right?
Supply and demand.
No, I get it. But that's what I'm saying. So like, if you're good at something, like it doesn't matter what it is, when you're good at that, like you said, this utopia world, but it's not that no one needs to work and like no one needs to do anything, but you need to create value into the world. Otherwise, if you don't create more value than you take out, you don't have savings. And then your savings can't go up or down in value or anything. It doesn't even matter. So that system, which is really a capitalist system, that capitalist system still exists because I need to create value into my community. Whether my community is 100 people in a village or if it's 1 million people in a city, I need to create value. And then if I'm able to create enough value that I'm able to not use all the value I create, I can save that up in whatever money there is.
Okay, so that value that you're creating, how do you value it?
Well, everyone values things differently.
How do you value it? Because let's say you go out and you charge a price for something, for your whatever your service is. How do you value it?
Well, it'll depend on what the need is for the person. Are you going back to supply and demand?
A little bit.
Well, yeah, of course.
Market forces. You're also going to look down the street and go, oh, here's this guy who does something very similar to me, and this is what he charges. But I think I do a little bit better.
Okay.
And I'm in demand, so I'm going to charge a little bit more.
Okay.
That's inflation.
That's not inflation.
It is. because now somebody to get what you're doing has to make more money somewhere else to pay for your service.
No, I disagree with that. That one I disagree with.
Then this guy over here is going to look back at you. We're in a closed system here. We're in a closed system.
Yeah.
That guy over there is going to go, oh, I do nicer work than Nick, and he's charging $2 more than me. So what am I going to do? I'm going to charge $2 more than him now. And we're going back and forth. So now, remember what I said, there's all these disparate systems with all these different people providing all these different services, and then they coalesce together. And all those inputs together create inflation.
But that's not inflation, because if there's no more money to pay, if the money supply doesn't grow for those whatever goods it is that I'm creating and the guy next to me, people are going to stop paying that price. Because if there was if we're just talking in a village, if there's $100,000 in the village, I'm only going to have, remember, closed system, that number's never going to change. I can't just raise my prices infinitely, because people aren't going to use that portion of the money supply for whatever good that is, unless the value of that good increases proportionately to the amount of that money that they're willing to exchange for.
Right. So if there's a fixed sum of money and people start to value things differently, then you get the opposite effect where you get deflation, right?
Provided that you have efficiencies.
So now you go back to a stage where your dollar is worth more next year.
Yes.
So what do you do with that dollar? You put it in your mattress. And you don't spend it.
Unless someone's creating... Like the
right? You can't have... Nick, you got to have it one or two ways.
No,
you either have inflation or you have deflation.
I understand.
And if you have deflation, your dollar is worth more next year than it is presently.
But if I need
don't spend it.
No, because if someone's providing me value at that moment, I'm comfortable exchanging money for value. Like you said, like price is one thing, value is the other. So I'm going to need, what if I could buy a new house and need glasses? I'm not going to be like, well, the glasses, my dollar is going to buy more glasses next year, so I'm not buying glasses this year. I'm going to just use my hands. You know what I mean? Like, that's not going to happen.
Nope. So you take it back to your A priority. What is the things that I absolutely need?
Yeah.
I need shelter and I need to eat. Okay. So I want to spend money on shelter and food. This guy over here doesn't have shelter or food. What's he going to do? He's going to come take my shelter or food. So what do? Well, I have to create a police force to enforce a state of harmony.
Okay.
Right? Because again, we're human beings. We have flaws, right?
So, but now we're talking about tax?
So that's one necessity is a collection of tax to be able to pay for a public service. Or it doesn't even have to be a tax. It can just be, I'm going to be the sheriff of the town, but I'm not going to do it for free, so you all have to pay me, right? So we keep building up these disparate services, right? Well, now you've got somebody over here who doesn't have a job. He's not providing a service. So then he wants to also be a sheriff. So then he's going to create a rival sheriff department. But how is he going to prove value? He's going to work harder than that other sheriff and provide an additional service to you, which then means he's going to try to charge more. Because if he doesn't, he's not going to get out of bed, right? He's not going to have a job. So my point being is that the system that works is capitalism. And capitalism works because of inflation. And if you don't have inflation and you have deflation, you can't have stagnation. You've got to either have inflation or deflation. Because there's nobody in control of that pricing power unless you have a central committee. And we know who used to have a central committee and where they reside in the world and how successful that went, right?
Yeah. Yeah, it's weird. I guess I have trouble following it, because if it all goes back to a value exchange. So if there's deflation because there's technological advances, so that I can buy more lumber next year than I can buy this year. If I'm a developer, well, I need to develop. Like, I need income. So I'm going to develop today, and maybe maybe it forces other things to change. Whereas I don't go sell, 500 homes. Maybe I actually I sell 20 homes, and then I do things that way. And then I sell those homes and I move on, because for the people that need the property now, like maybe there's other things that change, but if as lumber runs in short supply, Because if there was an abundance of it, it's at one price. And even if there's deflationary forces, if lumber runs in short supply or any other, anything else we're talking about, well, naturally the price of that is going to change even in an environment where we don't have an expanding money supply.
Sure. So you have deflation in lumber, right? Which means that a house will cost less to build, right? Which means what's going to happen? There's more people than there are houses, so they want houses, so they're going to ask for more houses. So then there's going to be more demand for houses.
Yeah, and
which means
more
lumber will be required, so the price of lumber will go back up, right? But
which you're saying, supply and demand, normal market forces. Yeah, 100%.
Exactly.
Yeah.
But the problem is that that's an isolated input. Inflation is the collection of all inputs.
Okay.
And when you break it down on an individual basis, you can define why there's been inflation or deflation to a price of a commodity, right? But what do we have? We have population growth. So we need more houses, right? All these things also then drive inflation, right? Which is why we've had inflation in Canada over the past 5-6 years, because we've had a much larger inflow of people.
Okay.
Right.
So let me ask you another question then, kind of around this. Why are the people that have a major, I won't say in charge of, but have a major say in the level of inflation experienced in this country, unelected officials? What's your opinion on that?
Wow.
Because you'd think something that is actively impacts the economy, in your point, and every single one of our savings accounts, investments, absolutely everything. These people are anointed. They are not elected officials.
Well, I would say it's a complicated answer, right? First of all, in order to be very good at that type of a job, you have to have a lot of education and then a lot of experience.
What makes you good in that type of job?
I think each individual has an inherent set of skills that are within their upbringing and their genetics that make them good at certain specific things. Okay. First of all, then you get an education in something and you're driven and you succeed at that education to be the best at what you are. So then you get hired by the best institutions that do similar things like that. And then that means you're also exposed to the best mentors.
What's the barometer? Like a thriving economy, that's what we want. Like, so we want GDP growth, top line. Do we want low inflation? Like what's the scorecard? Like what makes them good? Like how would you look at a central banker and be like, that was a good one?
Yeah. Personally, I would say stability.
Okay.
And that's what, if you listen to what Jerome Powell said in the number of Fed meetings that he's had over the past decade, he always talks about stability. And that's what the market loves. That's what human beings love. We love safety and going back to, we talked about chaos earlier. We love to try and define chaos and a set series of parameters that work consistently so that we can take risks that we believe are measured. Because very few people want to take risks that aren't measured. And the people who are ultra wealthy generally are people who've taken risks that you or I would not take. Right.
Yeah. That's fair.
And that's a genetic sequencing or a nurturing that's happened somewhere in their life that's allowed them to take a risk that most people would not take, and that either worked out for them and we know their name, or didn't work out for them and you have no idea who they are.
Yeah.
Right. So that's
or it worked out for them and they're even the best scenario is it worked out for them and you have no idea who they are. That's the utopia. That's the utopia. Yeah.
So again, if I take a look at a central banker and say, well, what, have they done a good job or not? I think you can only judge that in hindsight. And I think you're probably best bet to judge it based on whether they've had a consistent series of outcomes where things didn't get too crazy good, things didn't get too crazy poor. They were just pretty darn level, right? Like a lot of people would have sworn by Greenspan, and then the financial crisis happened and it's like, oh, well, here's the fingerprints that are on things that led to that. And some people would point to Greenspan and say, you know what, maybe he wasn't that great.
Yeah.
So then was Bernanke great because he came in and shoveled the proverbial to make things better? Does that make Bernanke great? does anybody remember Janet Yellen being the central banker?
I thought you were going to say great, and then I was going to say no.
See, because the point is okay, was she good because we don't remember her because things were fairly stable under her? It's an objective question, but the point being is I don't think elected officials can do certain roles for multiple reasons. Number one, because politicians are generally career politicians. Bankers are generally career bankers because they've got an education, they've put in the experience, they've had mentorship to get them to where they are. If they then suddenly had to run for office, they wouldn't know what they were doing and they'd get run over by somebody who did know what they were doing.
Yeah.
Right? So then how do they become elected? And then how do you get voters? You get voters by doing popular things. Collectively, what's popular hasn't always been what's best.
Yeah, like a lot of the handouts that we're having. Like, I'm not against social programs. I'm actually all for social programs. I just think what's happened is the way we've developed things is we have a lot of social programs that probably aren't necessary, and we need to take those funds and put them to what social programs were meant to be. Is like when people are in need to help them. Mm-hmm. And then when we do certain other things in the economy, we force other people into a situation of need that wouldn't necessarily be there. And then it puts a strain on the system, just like it puts a strain, sometimes different things on healthcare, education, transportation, and then it kind of breaks that system apart. But again, that's a whole other conversation there. Look, we're going a bit long. Do you still have more time, or do you have to?
My daughter's not done at the daycare for another hour and a half. So
okay. No,
traffic will depend on how long it takes me to get there.
Yeah. Well, no, I appreciate talking to you because I actually enjoy different point of views because it challenges me to question my own. So that's why I like it. And some people can bring, like we were talking about earlier, just have an emotional point of view no matter what. And yours isn't like that. And that's why I respect it. So I appreciate it. Whether I decide to end up agreeing with you or not, or you, me, I actually don't care. It's just a good conversation. So I appreciate it. Mm-hmm. Okay. So you don't like, you told me at one point, you're not a fan of gold. And I asked someone to bring the chart up because I saw a compound annual growth rate of gold from, I think it was the year 2000. It might have been earlier. And I got to be honest, it's the rate in Canadian dollars, mm-hmm. the compound annual growth rate, it surprised me. Mm-hmm. I was like, wow, I wouldn't have guessed, and I own gold, mm-hmm. and I wouldn't have guessed that's what it did. But anyways, I feel like it was, I'm just going to be pulling a number in my hat, and I asked someone to look for it, and they haven't got back to me. So
yeah, I don't know what it is, so I'm not going to begin to guess. And even if I did have an approximate figure, it would be in U.S. dollars because, of course,
That's the global. But explain. So you don't like it because it doesn't spit off cash. Is that why? And that's why I looked at my phone earlier. I wasn't listening to you. That's what I was doing.
So sure, that's one reason. But again, what does it do? It has no functional purpose other than to provide another benchmark, right? It's just a benchmark of how much your dollar has deflated, really. Because what you're talking about is the fact that the Canadian dollar has deflated relative to gold. Mm-hmm. Not necessarily how much has gold inflated.
You're right. Or it's held. The purchasing power has been held.
Exactly. Yeah. You can look at it two ways. The Canadian dollar has declined relative to gold, or gold has inclined relative to.
But the Canadian dollar's declined
relative to U.S. dollar.
Well, to everything.
Not to everything. No, it's relatively.
I guess what TV, other than technology.
It's relatively stable to like the Australian dollar. It's relatively stable to other economies where the primary export is commodity.
Sorry, I was looking at goods. I was looking at hard goods.
Yeah.
Because the price of everything's gone up.
Sure.
Yeah.
So like the Canadian dollar is largely driven by our exports, which is largely, oil, gas, minerals, et cetera, et cetera. The currency that's gone up the most over the past decade has been where there's been the most technological innovation, right? There's been productivity growth and technological innovation in certain centers, and those centers have driven a stronger currency because technology has been the driver of the growth that we've seen over the past 15 years.
Yeah, okay, that makes sense. And I found the chart, and so I'm curious. You got to take a guess. From the year 2000, the compound average growth rate until it looks like the end. I don't know if this was the end of 24 or sometime. No, it said 24 year to date. Just take a guess. I'm just curious because it's not like it's this outstanding return.
It's good. Canadian dollars?
Canadian or U.S. is actually very actually, it's only 0.1% difference, actually.
Interesting.
Yeah.
From 2000.
From 2000, yeah.
Oh, yeah. I mean, I guess the FX rate at that time was probably pretty similar.
Maybe, yeah. But take just a while. Look, I don't expect you to know this.
12%.
Oh, you guessed that high? See, it's 9.4 it came in at here. And I was surprised it was 9.4. That surprised me at 9.4 because I guess it's been so long, it didn't do anything for so long, right? That I know last year was a big year for it.
That's another difference between individual assets and indexes. Indexes tend to grow or decline in, like we think about the S&P 500, 9, 10, 11% per year, where the return of an individual asset tends to be very asystematic, where it's like, okay, it does nothing for 2 or 3 years and then it goes up, percent or 200% a year, right?
Yeah.
And then you look back and you go, oh, the 5-year average was 15%. And it's like, yes, it was, but really it was 0, 0, 0, and then 100. So that's another reason why buying individual stocks is more challenging than buying indexes, because indexes tend to go up or down. You see a direction, but a stock might trade sideways for 2 or 3 years. Not completely zero, but in a very meaningless sideways trend before it really blows out.
That's interesting because Dennis Lagoe way back told us, he goes, the businesses that I've seen, he goes, like the way that the businesses grow is they pop up and then there's this exactly what you're saying. There's just this leveling period, and then there's like nothing, and then there's growth again. But there's, so everyone just sees the growth portion. They're like, oh my God, can you believe it? But they didn't see the 5 years prior where there's all the foundation being built for that. And I know because you have private placements as well. And it's interesting because, not many people bring me that type of stuff because we don't talk to a lot of people that do that type of thing, to be fair. You're a very part of a very select few, Sean,
I appreciate that.
So,
and that's all thanks to Dennis again, bless him. And
yeah. And, but it was interesting to, because you've brought me some things that I'm like, I've never heard of this thing. I still have never heard of this thing, but I know that it's doing very well because I know some people that have invested in it with you and they're like, I think BlackRock bought into that one and there was a valuation that's been good. You know what I mean? And it's, but for a long period of time. So this thing could hit the markets all of a sudden and it could do very well. And I'm like, what the hell's that company? And then all of a sudden you just, you don't realize that for the last, 5 years or 10 years, there's been all this work and research or whatever going on with things like that. So,
and that particular investment, it's in what's called targeted radionuclide therapy, which is a type of cancer treatment.
As soon as you said the word, that's why I got scared. I'm like, I can't do it. I don't understand it right away. I'm done.
Yeah. So as John likes to say, it's like you find a smart locator and you find a bomb and you put them together and it becomes a smart bomb. And that's what targeted radionucleide therapy is you try to find something like a protein that attaches to cancer cells only, and then you attach an isotope to it that decays, and it decays in a very predictable, stable way, and that will decay on the cancer cell and kill only the cancer cell and not the other cells surrounding it. That's essentially targeted radionucleide therapy in a very quick.
Sure. Yeah. I'm sure it's more
so this investment we began being involved in 2018, but it actually the science behind it was going on for a decade or so more. Prior to us investing in it, and then it's continued to go on, over the past 7 years that we've been investing in it, and it's remained a private business. Now, the interesting thing about a private business is it's very different from a public business because it's generally going to be valued a lot more based on its revenue growth, and then any fundraising rounds that go to have new investment capital. And why would a private business want new capital? Only to expand and grow. Whereas in the public market, it's as Benjamin Graham, the mentor to Warren Buffett, said, over the short term, the markets are a voting machine, and over the long term, they're a weighing machine. And what that meant is that really the voting machine part of it is capital flow, right? Why does a meme stock take off or whatever? It's because a lot of people are interested in it and they're flowing their capital to it. You have a great demand for a stock and a limited supply, so therefore the price is going to increase until it finds an equilibrium, right? That's not how the public markets work. Or that's not how the private markets work. The private markets work on a fundamental basis where you say, okay, this is my revenue, this is the projected revenue growth.
Yeah, like a real investing.
In a way,
I shouldn't use the term more real, but
let's call it more fundamental.
Yeah, okay.
Than asset flows.
You say things. Right? You just pick better words than I do. Right? I just blurt stuff
You
out.
can thank the regulators.
Yeah.
So at any rate, what we hope is that when that investment goes public and people start to pay attention to what the business is doing, that they'll be willing to pay a lot more than what we paid for that investment. But in the meantime, I mean, it's done wonderful things, for patients, for cancer research, for things like that. What's great is we have a number of doctors who are invested in this. And they say, when you first brought this to me, I understood the science, but I really wasn't sure that this is what was going to happen. So I put some money in, and, we've done a couple raises through the years, and each time the doctors have put in more.
Yeah.
And then more,
because they're starting to see some stuff around.
And now it's just I saw last week the Ontario government has paid for the first procedure using this.
Oh, really?
In Ontario.
Oh, wow, that's
cool. It was approved by the College of Pharmacies in across Canada late last year, and so it's starting to come to Canada. It's already been happening in the United States, and prior to that in Germany, where it was sort of developed and
that's all. That's beyond the investment side, that's just good news all around.
It is. Listen, and that's where it comes back to, like, could I buy gold? Yes, but who's it helping? Mm-hmm. Could I buy Bitcoin? Yes. But again, what is it functionally doing for our society? Or could I give money to a company that's innovating cancer treatments, that's making, when you talk to somebody who's going to have radiation, what do you think? You think their immune system's going to get shot. You think their hair is going to fall out. You think their body's going to fall apart, but at least they may beat cancer if they get it all. Got it. Right? Okay, well, now those side effects are falling off a cliff. The question of, have we missed any? Well, if you're targeting the entire body with the treatment on a cellular basis, well, you're not necessarily as worried about missing it. And so all these positive outcomes where it's less stressful on the body, it's across the body instead of a targeted beam on a specific area. So all these benefits, we're improving outcomes for patients, for people who are in their most challenging years with the most challenging side effects that, they're the ones who need our help the most. So those dollars are going to something that's
cool. Right? That's very, very good.
So if we can make money at the same time, doing well and doing good, that's a great thing.
So you don't think there's any place for some gold though? Like, I'm just curious. So if you looked at the CPI rate, or now that we know the CAGR of gold, and if you looked at the CPI rate, or if you looked at the money, the cost of the money, it still outperforms that. And maybe it's not helping, in this instance, this cancer investment. I'm sure not all the investments you've done are cancer ones. So you've cherry picked a pretty good one to say, oh, we're making
brought it up.
Different. Yeah. So I walked into that one. So, if people are holding purchasing power in gold, it's exceeding that, and
so
they could do something. Well, they can do something in the future. Right. No, I'm not like take all your money and buy gold, but whatever, 2%, 5%. Like you don't think there's room for allocation. So your opinion, like I'm not. There's no perfect answer. I get it. You know what I mean? I'm just curious.
Yeah. And again, this is my opinion. This is again the great thing about what I believe is my role as a portfolio manager is, I want people to work with me because of my opinions. If they don't like my opinions, there's lots of other people with different opinions. Yeah. Right.
Well, they can still invest with you and do other investments too.
Sure. I mean, these are my opinions, and they'll suit some people. They won't suit others. Circumstances, personalities, etc. Right. So I don't have a lack of things to invest in. I have a plethora of options, and I've got to turn stuff away just because sometimes I don't even have the capacity to A, learn about it, or B, maybe invest in it. Maybe I just don't have the dollars, or clients don't have the dollars. They're fully allocated. So when just
low on the list.
Yeah. So just gold is just super low on that list. There's some people who, for personal reasons or familial history reasons want gold in their portfolio.
Yeah. There's some culture. Some people, it's a cultural reason too, right?
Am I going to tell them no? No. I mean, it's their money, right? Yeah. We're just trying to, provide a service, and okay, maybe that makes sense for their portfolio, but just generally, no, I've got so many other things that I could invest in where I'm not going to debate that it's not of value to somebody, but it's not of value to me.
Got it. Okay.
And so I wouldn't generally put it in a portfolio.
And is it the same with Bitcoin? That's how you look at Bitcoin as well?
That's how I look at Bitcoin as well. Yeah. And the thing about real estate we talked about, I can't remember whether this is before the podcast or during the podcast where you mentioned, the Toronto Real Estate Board and how that's done, right? So when I take a look at that, I would go, okay, well, real estate has clearly kept up with inflation. I think, it was relative to
We
the
said
M2,
it's about,
right?
yeah, relative to M2.
Okay, so it's matched your definition of inflation and keeping up with it,
Yeah.
right? But if you didn't own it to live in, you owned it to as an investment property, you probably rented it out. So you had that asset growth, plus you had income in the meantime.
Yeah, it becomes a self-liquidating asset, and I've used leverage, so my return is actually multiples of the 7% we're talking
Exactly,
about. Yeah.
exactly. So that's where I come back and I go, all right, well then now I could buy gold and, beat the M2 supply, or I could buy real estate and match the M2 supply,
And
but
it's
also
off
have
income.
leverage and also have income. So again, it's not a question of, why gold or why not gold. It's just more like I've got a bunch of other things that I can invest in.
Yeah.
When it comes to real estate, I mean, we have housing shortage in this country, right? While also trying to grow through immigration. So why would I not want to invest in the development of new townhomes? Why would I not want to invest in the development of new apartments? We have an aging baby boomer population. Why would I not want to invest in long-term care and seniors housing, right? I mean, because again, all these things are necessary. Mm-hmm. And if I can earn a reasonable rate of return, if I can match or beat inflation, depending on how we measure it, and I can also do good for society, well,
Yeah.
listen, everybody's winning.
Yeah, I got
and
it.
that's the utopia of capitalism, right? Can we not all row in the same direction?
No, that's cool. Yeah, I
and
agree.
try to benefit, right? And that's what we're trying to do.
Yeah. Okay. No, that's fair. And then, so we've gone long. I just want to ask you one or two more questions.
Please.
We touched on Bitcoin, so of course I have to bring it up. Mm-hmm. So I'm just curious as to your thoughts, because, before it was kind of taboo, mm-hmm. and then some big financial institutions started opening up these ETFs. So it became less taboo last year, but pretty much about a year ago. Right. Mm-hmm. Mm-hmm. So, in the more traditional finance world, became a bit less taboo, and everyone's still got their opinions around it, be it what it may. But if the compound annual growth rate, the lowest 4-year compound annual growth rate in Bitcoin's history is about I think it's mid 20. I'm going to mess up the numbers. I always forget. I want to say it's 29, but it could be mid 20%.
Yeah, it's been tremendous.
The average 4-year compound annual growth rate is about it's low 40s. Mm-hmm. And I'm just curious, like in an environment like that, do you feel like it's something that there should be some attention give it? Like if I was in the financial world, I'd be like, well, this thing's weird. I don't understand it. I can't hold it. It's nothing. It doesn't do anything. It's just this virtual nothing. But should I go learn about it? Because there might be something going on here. Mm-hmm, MicroStrategy, I mean, you're familiar with the stock. Like they've just basically, they're just playing the markets because they know a lot of institutional money want some Bitcoin exposure. They can't get the Bitcoin exposure. So they're like, hey, we'll give it to you through our company. And they're just kind of, they're issuing, basically zero coupon debt.
MicroStrategy is super interesting because what have they done? Well, they've issued debt in US dollars in order to buy Bitcoin. And this is what's really awesome about it, is because and why inflation is a good thing, because governments or corporations borrow. That's a given amount where I say, okay, today I've borrowed, in 10 years I'll give back. Well, what's happened in 10 years? The 100 million that they've borrowed has declined by inflation.
Sure.
So what they pay back in 10 years is not what they borrowed. It's less inflation.
Yeah, he's playing the system, right? For sure.
Exactly. Yeah. And then you are also investing in an asset that has had tremendous compound growth. So it's a really interesting case study.
But shouldn't every financial, not even MicroStrategy, but shouldn't every financial person be kind of like at least don't you think there's a place to educate yourself on the ins and outs of Bitcoin? I'm not talking you. I'm talking as a financial person. Just because, if I think one time when we spoke, you're like, look, there's never really been anything like it, and then isn't it to understand and then agree or disagree? Because I just hear so many people, they don't actually understand it, and they're just like, well, I don't like it.
Yeah, no, I mean, listen, it's a complicated concept, and I mean, the question becomes, well, what's the difference between understanding it and investing in it? Like, I have read a tremendous amount about it. You've shared some great books with me through the years, which I've read, and I've also done my due diligence on understanding it. I still have not put a single dollar of my money into Bitcoin, right? I have a tremendous shame and FOMO.
No,
right?
you don't have to.
But
no reason.
But generally, I do, because my job as a professional is to try and make people money. Like if you scrape it down to, whatever a priori, it's to make people wealthy. And somebody a decade ago could have spent $35 to buy a token.
Yeah.
And that token today is worth, $100,000 or more. So if that's not one of the single greatest,
don't put your shame on me, okay? Because I don't want to think about that right now. Yeah, no, but yeah, I get.
If that's not like the single greatest money creation thing that's out there over the past 2 decades, then I don't know anything, right?
Yeah.
It is, but have I done any of it? No, because when I take a look at it, it's just it doesn't, to me.
Do you think it's just a massive bubble?
I think it's a massive proof of what collection of people all believing the same thing can amount to when it comes to money, and when it comes to having a plentiful amount of that money.
Yeah.
Right. Like, listen, the thing is that the concept behind Bitcoin was never meant to really be what it's turned into. Right. Like, if you read the original manuscripts, and it was an idea of how can we tokenize the world. Right. Okay. Well, you've created a token. That token was meant for fungibility. It wasn't meant.
It did put reference into central bank money printing into the code.
It wasn't meant to be a speculative long-term holding asset.
Got it. Okay.
Because the thing is people who have made the most money in Bitcoin are the hodlers. Right. And so therefore they are removing the fungibility of the asset. Saylor going out and buying, all this Bitcoin, he's removing the fungibility of the asset, right? And eventually Bitcoin will rise to such a degree where, is it going to truly be a fungible asset? And then we've kind of lost what we got into it in the first place. And all it takes is that collective mentality to change. And then you have more supply than you do demand. To this point, we've had more demand than we've had supply. But if the mentality changes at some point in the future, I don't know what will cause it to change, but history shows that people change their mind.
Well, there's cycles and everything.
Sure, exactly.
There's a lot of people that look at the global M2 growth and they map it against the Bitcoin price, and when you look at those numbers together, you're like, well, they correlate quite well.
But what's the end game for Bitcoin? What happens when all the Bitcoin is held by the large institutions and the large investors?
Yeah, I think a lot of people believe that, like, for Bitcoin to succeed in the long term, it does need to be used as an exchange of value, as money over time. And that's why there's technology being built on top of it, these layer twos, to increase the speed. Like, there's something called the Lightning Network, which you can, it's virtually free. It's costs like fractions of a penny to send money virtually instantly as well, to do payments and that type of thing. And they're like, yeah, if that doesn't take hold further, and the Lightning Network, the number of transactions, the volume going through the transactions is growing rapidly when you look at the charts. But it's like one of those things, like, it's growing very quietly. No one's looking at that, but it's the technology being built around it to facilitate that is there, and it's growing fast. Which
is a wonderful thing, but it doesn't make it an investment. And so what's really interesting is I hoped you brought this up, because I was out for dinner with a bunch of daycare parents over Christmas, the one time a year that we can get babysitting coordinated and all go out for dinner. And, the one guy was asking me about Bitcoin, because he's like, you do investments, let's talk about it.
Sure,
right?
It's top of mind.
And I said, well, what's your experience with Bitcoin? And he said, well, I've never owned any Bitcoin, but I've paid bills with Bitcoin. So his IPTV that he was using, he was paying with Bitcoin. And I said, now think about it. All those months you paid with Bitcoin, what if instead of paying with Bitcoin, you bought Bitcoin?
Yeah. But you can just, that's just his turn. But he could have just use the cash to buy Bitcoin and then send the Bitcoin.
Well, that's exactly what he did. But what if he'd used that cash to buy the Bitcoin, and then he decided, well, why am I spending an asset?
Yeah. So you're going back to our inflation talk?
Yes, because again, if Bitcoin is an asset that is going up in value, why would you want to spend it for something like TV?
Yeah.
You wouldn't. So then, is it an asset and a store of value, or is it a currency? Because if it's a currency, he spent it to buy his IPTV, which is what he wanted, and it was a transactional medium. Okay, great. Done. Except that he can look back with regret and shame now and know that he spent $100,000 on TV for years.
Yeah. Or you left one word out. Or is it money?
Well,
because currency isn't money.
Sure.
Right. But there is a distinction there.
Sure.
Like,
I appreciate what you're saying.
And that, like, that's the one thing that, because you're right, someone would hold the Bitcoin, but if you're using that logic, then why the hell do we have any of these stupid dollar things? Because they're just going down in value.
Listen.
So it's the same argument on the other side.
It's because the dollar going down forces us to spend it.
Yeah, so you're saying that's the only thing keeping the economy going. Or it's not the only thing, but it's a very strong factor for why our economy exists as it is. And without inflation, our economy starts to falter a bit, is what you're saying.
Exactly. Every time you sell an asset, you're buying a dollar. There's two parts to that equation.
Yeah, I got it.
You're selling an asset and you're buying a dollar. What do you want to do with that dollar as soon as you have it?
Get the hell rid of it.
Exactly. Which is the point of currency. That's the point of it.
Yeah.
Fungibility. That was why it was created. Beans, tokens, seashells, bitcoins. The point of currency.
Well, no, hold on. It used to be pegged to gold. And it wasn't. The point was to actually not have to transport the gold from one place to another. It was a gold receipt. That's initially.
Yeah, gold.
But there was no inflation at that time.
A gold reserve.
Yeah,
gold reserve.
So because it was pegged to gold, I have some of those. It was like a CIBC, an old CIBC banknote. It wasn't a Canadian dollar. It was a CIBC banknote that I have one of those. So, but it wasn't around inflation, and that's why it was created, right?
Yeah, but then everybody realized that the United States and the corporations that exist there are worth way more than gold.
Yeah, or they took it off the gold standard. So
because the earnings power of the corporations and the people of the United States is far greater.
Is that why?
Than gold.
So then why were because when they did that,
why does anybody borrow U.S. dollars?
No, but what happened is the other countries that the U.S. was holding their gold, they were all starting to come take their gold back, and then that's when the U.S. did it.
I mean, it's also the turn of them taking over the world as the leading power, thanks to their technological advancement. Why are they the best country in the world? Militarily and economically, et cetera, because they allow the greatest flow of information exchange and innovation that exists. There is no greater earnings potential than the innovative mind of the collective group of individuals that are in that geography or domiciled in that geography.
So if they're smart and they start looking at Bitcoin as a reserve asset, is that smart or is that Trump being stupid?
Listen, when you have the power of the reserve of the United States buying an asset, it gives it its value.
Yeah.
Right?
That's fair, yeah.
Listen, I mean, if you think that Bitcoin is going to become a reserve, then it clearly has a value, has whatever value that the largest holder of Bitcoin tells you is the value. And if that becomes, the United States reserve, then listen, I'm not going to debate with them on that.
Yeah.
There's no chance. But at the end of the day, a currency is meant for fungibility. Okay. And why would anybody have ever spent Bitcoin to do anything given what's happened?
Okay. I want one other question, then I'm totally done. Okay.
Sure.
Because we've gone really long. We don't normally go this long. I'm curious as your thoughts of something. So I'm going to use Bitcoin as an example. It doesn't have to be Bitcoin. It could be glasses. It could be wood, anything else. But the way our system is set up right now, so asset owners are getting richer. People without assets are essentially falling further behind. I think we can kind of both agree to that for the most part, right?
1,000%.
Okay. So you have people that are on the lower end of that they don't have assets, but they're trying to save up and they bust their ass. They're working their flipping ass off and they're like, hey, I'm creating value. I'm working 3 jobs. I'm doing whatever it takes and I'm saving some money. And then and the reason they're saving money is because they want to buy assets. So call it a house. They want a house for either themselves or their family, and they think they think that's a good decision. We don't even have to debate that one way or the other. But what's happening is their savings keep getting devalued, and this asset inflation keeps accelerating because of the growth of our money, asset inflation, whatever. So over the last 20 years, it's been pretty extreme, right? So they've not been able to keep up. That savings it's never been able to keep up because the value of that savings keeps falling further and further behind, no matter what they're trying to bust their ass. However, if they saved in something that was like a Bitcoin, that was the purchasing power of that went up, they would have then actually been allowed to exchange that for a portion of the property, like a down payment, and then get into the asset world. And sometimes I look at that and I'm like, is there a solution? And I'm not saying it's Bitcoin, because I'm not even going to go there, but is there a solution that if we provide something else to store value in, does that help equalize society? You know how you're talking that different investments don't do anything, but if something like that, like, doesn't it really actually, can't it actually really do something? Because I'm trying to figure out, like, there's actually really good in that environment, and our system's so screwed that a lot of inequalities are from the flipping system.
So
they don't shut up, and we'll end it after.
No, it's all good. I don't know that the system is necessarily to blame. I think education is to blame, and I think human nature is to blame, and I think the way we look at money is to blame. So, there has never been a cheaper, less hurdled time to save and invest, not save and put it in a mattress known as a savings account,
Yeah.
but to save and invest than right now. You can, on your smartphone, you can open an account with a discount broker or a robo broker or
Yeah, it's pretty easy.
what have you.
Right.
You can pick up the phone and call somebody like me, what have you. And the barrier to entry has never been lower. Some places will allow you to buy stocks and ETFs for no cost, right?
So they should be taking that.
But why don't we do it? Why don't more people do it? Because they're afraid. Why are they afraid? Because they're undereducated on the topic. It comes down to education and then the inherent nature of humanity. And because the people who are poor are systematically poor, like where it's generational, their parents didn't have the conversation about money with them because they didn't know how to have that conversation. And their parents didn't know how to have that conversation. Maybe their parents came from a failed state or grew up in the Depression and never got over the shock of that, or never got over the system of economics that existed in the place that they were from before they emigrated here. And it's an educational gap, and it's a human nature in how they were raised gap. And I don't know personally how to correct that, except to try and better the education that we give everybody. So, like you asked me, why are we having this conversation today before we got on air? And I said, it's because I want to have a conversation about money that maybe somebody listens to and learns something. Yeah. Because education is what we have to give. It's what my responsibility is to give my partners and anybody else who I can reach out to. If I can be in a high school, and talk to kids about it, I'd happily do it. If I could talk to my own kids or my, cousins and et cetera, it's just about having that conversation and trying to overcome the fear, the preconceived notions, to go, like, listen, we are living in the golden age of access to assets. You can fractionalize your shares, you can buy Bitcoin, you can crowdsource, it's never been easier.
Yeah, no, I get where you're coming from, and you did, and I appreciate that. You said when you came here, it's just like, look, I'm kind of like, you're pretty much not tapped out, but it's just like you're quite full on your client plate to begin with. It's not you. This wasn't a promotional thing for you. You said, I'm actually here. I'm just hoping that exactly what you said. You're just hoping people maybe I can share something, have a good conversation about money. And I respect you for that. And I appreciate you coming in and taking the longer time, and we'll make sure we get you back to your
maybe we split it up and have 2 podcasts.
Yeah, we could do that. There's so much else to talk in this world. There's so much to talk about, right? Because there's other stuff that I didn't even get a chance to bring up. But is there a website or something, like if people are kind of wanting to reach out to you, or has, like, if is there something you wanted to share? Just you guys have a newsletter that you guys send out to?
Yeah, so I mean, my website is teammoir.com, teammoir.com, and I've got a newsletter. You can scroll down to the bottom and sign up for the newsletter. It's written by my dad and mentor and business partner John. And then my firm, where it's a CIRO registered Canadian investment regulatory organization, registered firm, Mandeville Private Client Inc. They have a website you can Google. And then, I guess what I would say to anybody is it doesn't have to be me, it doesn't have to be Mandeville. Just get out there and ask questions and engage your mind. As we talked about in the beginning, just be engaged, because if you don't engage, you're going to get left behind, as you just pointed out, very, very astutely. And it's like you either have assets and you're accumulating assets, or you don't. And every day that goes by that you're not doing that and you don't, is a day you're getting further behind.
I think that's the best way to sum it up. Whatever it is, you either have assets or you don't. And there's in today's world, there's a real difference. And you want to try to figure out the way to be on the have side of that equation. So yeah. Thanks so much, man. I genuinely appreciate it. I appreciate you. I appreciate the conversation for sure. Thanks.
Absolutely.